concepts, gave them new names like order blocks and fair value gaps, and sold them back to you as hidden knowledge. In this video, I'll you the original patterns side by side, so you never have to pay for this information again. Market structure stands as one of the purest forms of price reading. Whether you call it price action or smart money concepts, the core stays the same. Price makes higher highs and higher lows in uptrends, lower highs and lower lows in downtrends. In basic price action, you spot a trend by connecting these highs and lows. A possible trend change happens when price breaks this pattern. Smart money concepts named this process differently, but look at the same thing: price breaking its previous rhythm. This chart perfectly shows how price action and smart money concepts describe the same market behaviors with different names. Price moves up, making higher highs and higher lows until a key point where structure breaks. In pure price action terms, you spot a trend by watching how price climbs in a stair-step pattern. Each push-up creates a new high, followed by a smaller pullback that holds above the previous low. Notice how in both sides of the chart, the pattern looks identical. That's because whether you call it trend continuation or break of structure, the price behavior stays the same. The market continues moving higher until it hits a point where the pattern changes. Smart money concept simply gave new names to these classic price patterns. Both methods pay special attention to these structure breaks at key levels. Support and resistance zones matter in both approaches. The market often changes direction at these points, showing shifts in control between buyers and sellers. Where price action traders see a trend reversal, smart money traders spot a change of character. Both describe that moment when price fails to make a new high and instead breaks below a key level. This horizontal line on both sides marks this key turning point. In price action, this represents a support level that, once broken, signals trend reversal. Smart money concepts call the same level a change of character when price shifts direction. Look at how price builds momentum before reversal. It doesn't just flip instantly. Instead, it forms a series of pushes higher, each one showing less strength than the last. This weakness shows up in both trade approaches. It's just labeled differently. All value higher time frame analysis. Structure on larger time frames gives control time frame moves. So whether you follow price action or smart money concepts, you watch the same price movements. You look for the same shifts in market behavior and trade the same opportunities. Order blocks represent one of the clearest examples of how smart money concepts relate to different patterns. At their core, order blocks mark areas where big market players enter trades with significant volume. In pure price action analysis, traders always watched for strong momentum candles that kicked off major moves. These candles stood out because they showed clear control, either buyers or sellers taking charge with conviction. Smart money concepts just gave these candles a fancier name. The mechanics stay identical. A bearish order block forms when price moves up, then reverses down aggressively. Price action traders always saw this as a supply zone, where sellers overwhelmed buyers. The bullish version shows up when price drops, then reverses up. This is what price action traders call demand zones. Smart money concepts added specific rules about these zones. They say the best order blocks won't see price trade past this candle. But price action traders noticed this too. They just called it a strong reversal level. The market maker angle explains why these zones work. When big players need to fill orders, they create artificial moves in both directions. They open positions at the order block level, making it a key price zone they'll want to return to later. This matches perfectly with how price action traders always viewed strong reversal candles. They knew these levels often got retested because they marked important moments. The smart money framework just explains why these retests happen. In fact, you'll often find order blocks at major market highs and lows. This makes sense in both approaches. These are the zones where big moves start and where trading volume concentrates. Price action traders always watch these areas for potential reversals. The validity rules stay consistent too. Both methods watch how price behaves when it returns to these zones. A true order block, like a strong support or resistance level, should show clear reaction when tested. Market structure plays a key role in both approaches. Order blocks matter more when they break nearby levels. SMC traders value a level that breaks the market structure. At the same time, price action traders always gave more weight to reversal candles that led to new high or lows. Both methods recognize that not all strong candles become important levels. The surrounding market context matters most. An order block, like any price action pattern, needs the right market conditions to work. I hope you understand that price tells the same story, whether you use smart money terms or price action language. Order blocks simply show where big players enter trades. Price action shows strong momentum shifts. Both describe the same market behavior, just with different words. Liquidity sweeps form a basic market pattern that existed long before smart money concepts named them. In SMC terms, you'll know them as liquidity sweeps or liquidity grabs. In price action terms, these are simply false breakouts or bull and bear traps, where price pushes past key levels to trap traders on the wrong side. You'll spot these traps at key market highs and lows. In an uptrend, price shoots below recent lows, triggering stop losses and scaring traders out of good positions. In downtrends, price spikes above recent highs, trapping late buyers before dropping. The mechanics work like this. Big players need to find enough orders to fill their positions. They push price into areas where they know other traders place stops. When these stops trigger, they create instant buying or selling pressure that big players use to enter their positions. Smart money concepts simply added structure to this pattern. They look for liquidity pools, areas with concentrated buy or sell orders. These pools often sit just above resistance or below support, where traders typically place their orders. The validation process follows simple rules. For a bull trap, price breaks above a recent high, then reverses sharply. For a bear trap, price dips below a recent low before bouncing hard. These moves happen fast, catching unprepared traders. You just need to understand how institutional traders use these sweeps. In bullish markets, they need sell liquidity below lows to fill their long positions. This fuels the next trend move up. They create these sweeps deliberately to find enough orders. During bearish swings, look for price to pull up to key levels. If no liquidity exists in previous moves, smart money will create it through these sweeps. They build a trap before triggering it. So when trading bullish markets, it's best to place buy orders after a bear trap. You're buying into sell stops, just like big players do. For bearish markets, you sell near recent highs after a bull trap. Whether you call this a false breakout or a liquidity sweep, this concept works because it exploits basic trader psychology. Most traders expect breakouts to continue. When price reverses instead, it forces quick exits that fuel the new move. Smart money concepts just explain the institutional side of this pattern. These sweeps often create decent reversals. Once trapped traders realize